Hey everyone, it's June 19th, 2015, and this is the first weekly video I've posted online as part of the complimentary service available to everyone. In this video, I want to give you a quick rundown of the weekly videos, give you an overview of the website and the two stock trading services we currently offer, and finally touch base on the S&P 500. Weekly videos will be 4 to 6 minutes long, and they'll be posted every Sunday on this website, on my YouTube channel, and on hotstockmarket.com. Weekly videos will be a platform, much like my blog, where I share my ideas with you on the broader indices, not just in the United States, but in Europe and Asia as well. I'll talk about the fixed income market and take a look at the currency market as well. On occasions, I'll look into specific trends, sector trends, and also they'll discuss individual names. However, I will not discuss specific trade ideas as those are strictly reserved for members. So about the website, we launched the service back in June 1st, and we've been running the service for a little over 3 weeks. Homepage, you'll have a brief description of the website, of the service, and an autobiography of the author. Performance, if you click on the Performance tab, you'll see the most recently closed trades. As you can see, we've only closed 2 trades so far. One's been a loser, one's been a winner. Net, on a realized basis, we're up. Of course, we currently have some open positions and are actively trading the markets. As results come through, I'll post those results online for you to take a look. If you're interested or thinking of joining, this is a good place for you to follow our progress and see if it fits your investment goals. As far as subscriptions, there's 2 subscriptions we currently offer: the stock trading service and the stock trading service and monthly market report. Stock trading service is a Monday through Friday stock picking service where every morning before markets open, we send you 4 to 5 trade ideas that we're looking to place that week. We give you the entire trade setup from entry price, target, stop loss, the risk associated with the trade, and even recommend the percentage of the portfolio that you should invest in that trade. That's calculated as a percentage of total equity. Every time we enter a trade or even exit a trade, we'll send you an alert directly to your email. The nice thing about the service is that we email you everything from the newsletters to the trade notifications to anything outstanding that may be of importance to you. Pricing starts at $50 a month and extends over to 3 and 6 months, with discounts being offered over 7%. The stock trading service and monthly market report is the same service as the first one, with the exception being that at the beginning of each month, we send you a comprehensive and detailed monthly market report that covers most markets, if not every single market. And I share with you a few sentiment, price, and volume indicators. Give you an overview of what the major indices did for the week, and most importantly, give you an expectation or my expectations on the broader markets. I'll specify specific price points to look for, and finally give you an overview or a review of our trades and how I'm looking to approach the market in the month ahead and how I'm looking to trade it. First service is designed for those traders who are actively trading the markets and just want to profit from our trades. And the second one is reserved for the student who wants to educate themselves and use the newsletter or the report as a complimentary service to the work they do. Blog, like I said, much like the weekly videos, it's a platform or an avenue where I share my thoughts with you. I'll talk everything from markets, economy, sector-specific trends, and it's a good, nice format, or it's a nice place where you and I can exchange ideas. You're more than welcome to opine, to give an opinion. The more facts we have, the better. But like I said, it is a great place where I share my ideas with you, and make sure to check it at least once a week to see what new blog posts I have up. And it's a good way for me to complement the service I offer. With that said, let's take a quick look at the S&P 500. Like I said, since this is more of an introductory video, I'm not going to go into much depth in the S&P 500. But what I will tell you is this: whenever I begin my analysis of any stock, composite index, you name it, I always look at the bigger picture. Bigger picture gives me an idea or a better view of the trend, bias, and momentum of any security. Sometimes there's a lot of noise in the daily and even in the weekly time frame. So for that purposes, I like to begin my analysis looking outside in and take a look at the bigger picture. Besides that, the bigger picture also allows you to isolate or extrapolate different events during different time periods and compare them over time. For instance, in the summer of 2012, when the entire European fiasco began, you saw that there was a negative shock or negative effect in U.S. indices. I mean, the headline event was that Greece was in trouble, Europe, periphery, all the countries in the periphery within Europe were in trouble, and the ECB at the time had a restrictive monetary policy. So, there was the fear that there would be bank runs because there was a liquidity crunch and whatnot. But that was the side effect. That was not the cause of what led to U.S. indices and European markets tumbling. Today we have a similar set of factors. Greece is potentially going to be kicked out of the EU if it doesn't comply to the demands of the IMF and the European Union. Yet we've seen the markets here hold on fairly well, despite the same rhetoric. So what I'm trying to get at is that by looking at the bigger picture, you can isolate different times in history, see how investors reacted, and by default, how price responded, and see if there's any similarities. If there are, will there be a corresponding price movement? And if not, why didn't price behave the same way? And what set of factors do we have to take into consideration going forward to see why there was such a divergence, why there was a shift or a change in response by the investor? So with that said, what I've drawn here is a Fibonacci retracement from the 2007 high through the 2009 low of the S&P 500, more precisely of the spiders. Basically, as you all know, Fibonacci retracements gives you area of support and resistance through whatever time frame you're analyzing the markets. They're very precise. For it's a ratio that builds on fractals and on itself, meaning it's not linear in its definition or its formation, but it's geometric and successive. So for that reason, it's very precise in most cases. It's more so precise, for instance, in the currency markets where there's less volatility. But the point I want to make here is quick. Fibonacci extension I've also drawn here, or that comes as a result of drawing the Fibonacci retracement, comes at 1.618 or 213.39 on the spiders. It's no surprise why the S&P has stalled at current levels from its 2009 low. People or investors that got into the breakout above the 2007 high were targeting 213.39 in the S&P all along. It was reasonable to expect these people to take profits at that level. To be clear, Fibonacci extensions should not be used as support or resistance bands like Fibonacci retracement points. Why? Because there's no price comparison to judge a Fibonacci extension from. In other words, Fibonacci extensions are projected price points through time and space, while Fibonacci retracements are based on price alone. They do not take into account time and space. Having that said, there's one of three scenarios that can pan out over the next few weeks. Yeah, S&P trades down, breaks below 2063, and trades down as low as 1920. It consolidates in the current range between 2063 and 2120, between here and the early to mid part of fall, before finding a resolution to the range, or it breaks out higher above 213.39 and trades as high in the S&P as high as 2181, 2196, thereby setting a higher base and consolidating in that range. Either way, there's not much upside and there's not much downside. You have to be careful, you have to be nimble, you have to be very selective, note what you trade, how you trade it, because this is a market that, even though it may seem like it's fairly easy to trade, just buy anything that may come down. You have to be very selective because there's definitely that feeling, or at least I get that feeling. They're definitely gunning for you. They know more now than ever where you're positioned, and I mean it's a market. They're gonna take you out. That's how other people make money. So you have to be. It's a very again. You can't trust the market. You have to respect it though. And with that said, watch for those levels: 213.39 on the upside on the S&P, 206.10 on the downside on the spiders, and as low as let me see, 191.82, and then yeah, and that's it. Again, this rally would not be called into question unless the S&P trades below 1870. If that happens, I would begin to question the overall composition and even the trend at hand, the longer term trend. So, I mean, we're still way away from that price point, and you have to remind yourself that 1870 is a price point we're looking at today. It's going to change as we move on through time. Okay. So with that said, thank you for taking the time to listen to the video, and I wish you the best of luck trading.